Thank you everyone for waiting in. I'm sorry. Thank you everyone for waiting in, and I'm sorry to keep you awaited. So we'll start. Bismillahirrahmanirrahim. Assalamu alaikum. Good morning to everyone joining us from around the world. A warm welcome to our exclusive global webinar, Beyond Compliance 2025. I am Rahim Aziz, the marketing lead at DD Consulting and your host for today's session. We are truly excited to have a diverse audience with us from UAE, Saudi, Malaysia, Pakistan, Australia, and beyond, and all here to gain valuable insights on the trends reshaping finance, regulation, and compliance. Before we begin, just a few quick points. This is a live interaction session, so please free to post your questions in the question and answers column, and then all these will be answered in the end. And yes, this session is being recorded and we will replay. The link will be shared afterwards after this call. Now let's dive into our first topic. Let us begin let us welcome our CEO and fellow actuary, Mr. Hussain Firoz of DD Consulting, who is a qualified actuary. He currently serves as an appointed actuary, peer review actuary, and actuarial consultant for several insurance companies, and has acted as an actuarial expert for numerous audit firms reviewing IFRS 17 results. He will share his insight on climate risk in UAE.
Thank you, Rahim, and thank you everybody for joining. So my topic of today's presentation would be climate risk. Let me share the screen and I'll start on the topic. Yeah, hope everybody can see the screen. So, so the idea would be that I will be covering the new regulation which Central Bank of UAE has issued recently with regards to climate-related financial risk. And my fellow speaker after me would go deep dive into this topic and would cover the strategy, risk management, and other considerations for this topic. I'll start off with an introduction about myself as well as about my firm. So I'm a qualified actuary with over 2 decades of experience in the insurance sector. I have mostly worked in the Middle East region, primarily UAE, as well as some other markets like outside Middle East, other markets like Pakistan, Nepal, or Malaysia. And I founded this company, DD Consulting, in roughly 2019. So for the last 6 years, we have been active in a few markets, and we have been supporting insurance clients in different requirements. So I'll just quickly cover on what our company is offering. So we have a vertical for actuarial services where we offer appointed actuary or product development or IFRS 17 services. So we have a large team with a few qualified actuaries. So we work actively with our insurance clients. The second vertical, where we have compliance and accounting experts in our team, takes care of AML or accounting related advisory services. It also includes ICOFR, which is also one of the topics of today's webinar, as well as E-Invoicing, which is again another topic. The third vertical is climate risk and sustainability services, where we work with clients for ESG reporting, or how Jayesh will talk about the other requirements like climate modeling or supporting in developing the strategy for this to mitigate this risk. The fourth one is Sharia consulting, where we work with the couple or Islamic financial institutions and help them on the Sharia audit or in helping them understand the Sharia structures for this. And the last one is training and development, where we are very actively involved. And this is, in fact, one of the example that today's session, we actively do training for the public, as well as we organize one-to-one sessions with companies, and the range of topics varies. For example, we cover actuarial topics or climate training related topic or ICOFR training, etc. So let me go straight now to the topic and give some introduction in the global context, what is happening on the climate risk front. So around the world, as we know that regulators and central banks have recognized climate risk as a very important risk element. We have seen growing convergence of standards. For example, IFRS S1 and S2 were issued in 2023, and they have become a global baseline for climate and sustainability related disclosures. Some developed markets like UK, Australia, or Singapore have already begun aligning with these frameworks, and it is expected that more and more countries will come forward and adopt these new disclosure requirements. Financial Stability Boards, with their 2025 roadmap, also calls on all regulators to embed climate considerations into prudential regulation. And generally, I would say from my experience of tracking this topic that initially, when it started off, there was a focus on doing a voluntary adoption as a best practice. But now more and more countries are embedding this into their prudential framework, which means it is becoming a regulatory requirement across financial system. Now, I would also like to give you the context of UAE and what is happening around, because you will see more regulations from UAE market. So why has this be the case? So UAE has taken a strong leadership role regionally. It was in fact among the first in the region to ratify the Paris Agreement, its net zero commitment by 2050 strategic initiative, and Green Agenda 2030, as well as National Climate Change Plan 2050, have all created a clear national roadmaps. Some of you may remember Dubai hosting COP28 in 2023, which was a big show, and this amplified UAE commitment and placed UAE, in fact, at the heart of sustainable finance discussions. The central bank's latest regulation also builds directly on that momentum to ensure that the financial sector contributes actively to this transition. First in this series was the very first regulation which came out was in year 2023, which was the Principles for Effective Management of Climate-Related Financial Risk. It was, and a background of this was UAE established a sustainable finance working group, which included representatives from most of the regulators within UAE, like Central Bank, ESCA, DFSA, ADGM, etc. And they all contributed towards the first regulation which came out. And the first one actually laid the principles or high level foundations on this topic. What we have now seen, the new regulation, which is notice number 5588, which was released in October 2025. So this is asking for turning those principles into binding prudential regulations for all banks and insurance companies in the UAE. So in a nutshell, it is no longer a guidance which was provided in 2023. The new one is making it mandatory for insurance companies to act on this very important topic. The current regulation defines two key risk categories, and in fact, these two categories, if you are following climate-related regulations, so you will often come across these two categories. So first one is physical risk, which is arising from floods, storms, or in general, rising temperatures, and the damages it is doing on assets or disruption of supply chain or increase in claims or defaults. So this is all categorized under physical risk category. The second one is transition risk, which is the risk resulting from policy shift or carbon pricing or technological changes as the economy moves towards low carbon emission models. So both of these risks affects the traditional risk categories like credit, market, underwriting, or operational risk, which is why it is important that we integrate climate risk into the traditional risk framework. It is not required that you create a separate risk framework for climate risk, but rather you have to embed climate risk into your existing ERM framework. Now, I will cover the new regulation issued by central bank in the next few slides. In simple terms, this regulation changes the definition of risk management. So it is requiring climate factors to be included in all the areas, from strategic planning and business strategy to capital adequacy and risk appetite, to liquidity planning and internal controls. So for insurers, this means greater linkage between underwriting strategy, pricing, and reinsurance structures, as well as for banks, it means embedding environmental considerations into their credit approval policies or policy concentration limits, etc. Now, some of the key pillars of this new regulation I would like to cover. So first one is governance and accountability. And as we know that governance start from the board of directors and senior management. So the regulation talks very explicitly that boards and senior management now have explicit fiduciary responsibility for climate risk oversight. They must assign clear roles, allocate resources, and integrate climate into decision making. The regulation reinforces the three lines of defense principles and calls for training and capacity building across all levels of staff. And as I mentioned in the beginning, that we have a separate wing for training and development. And through this training team, we are already supporting some clients towards their capacity building or towards giving them the right training to make them aware of this climate risk related components. The second key topic within this regulation is risk management and climate modeling requirements. So the core of this regulation lies in risk integration and modeling. And as I said that we are not required to treat this subject standalone, but rather climate risk has to be integrated within our existing risk frameworks. So most people from insurance companies would know that central bank issued the risk requirement sometime in 2023, and there is a requirement to prepare ORSA reporting from 2023 onwards. So the ORSA requirement, which is currently applicable, needs to be modified so that every insurance companies cover climate risk and look into each element of their risk framework and see how this affects their existing risk frameworks. So in a nutshell, like integration of climate risk into risk framework is very important. The second is the data and metrics. So here, central bank has already started collecting data from insurance companies. So this is going to grow even more. And for that reason, we are seeing a growing trend that insurance companies are collaborating with third-party companies to automate the procedure of data collection, because a lot of data requirement and compilation is new. And which means that you either modify your current system or you work with third-party vendors and integrate the new data requirements into your existing framework. And the third requirement is scenario analysis and stress testing. So here, firms must model multiple climate pathways. For insurers, that means that they need to evaluate how extreme weather events could affect claim frequency, severity, or reinsurance cost. One example I would mention here, we all remember the floods, the extreme floods which happened in April 2024, and the damage that they had on the financials of insurance companies. So at that time, the requirement for scenario analysis was not mandated, and for that reason, most companies had no idea how much it could affect on the balance sheet. But now this has come as an explicit requirement. So companies will have to model the scenarios and see how much it affects your solvency, your capital position, your balance sheet, etc. Now, model validation. So companies will have to either build their internal models or will have to work with consultants to assess climate impacts and validate those new models and benchmark it against the global guidance. So simplified approaches can also be taken for smaller entities, but because there is a principle of proportionality proportionately provided in the regulation, but that has to be transparent, and you should be able to explain it to the regulator why you have taken the simplified approach. And the last thing which comes under risk management is the monitoring and reporting requirement. So companies will have to continuously monitor ISKI and regularly report to management and boards in form of summarized exposure, scenario results, and action plans. All of the stuff that I talked about in risk management and climate modeling. So you probably know that actuaries are well placed to handle this. And for that reason, we are offering this services to our clients, whether it's preparing financial models or whether it's making sure that the ERM framework is well integrated with the new requirements of climate risk. Now, what are the implementation guidelines for this new regulation? So the regulation will come in effect. It is released in October 2025. Those institutions which are not fully compliant, they are required to submit an implementation plan to the central bank with clear timelines and milestones. And board of directors must review progress reports. So the CBUE may request a scenario analysis result as part of their supervisory review, which is signaling that quantitative assessment will soon become like a standard practice. There is a possibility that if companies would ask for a much longer time period for implementation, then the regulator may step in and ask them to make it as a priority and reduce the timeline. So we have yet to see, because the regulation just came out last month. So we have yet to see how the market reacts and what are the accepted timelines from the regulator. But what is already required is a action plan that companies need to submit to central bank if they are not already compliant with this new regulation. Now, global outlook and global updates and future outlook. So, as I said, UAE is moving towards the direction and trying to align itself with the development in the rest of the world. As more jurisdiction mandate climate disclosures, what we can expect here that mandatory climate stress testing will happen on an annual basis. Public disclosure requirements may be mandated, such as IFRS S1 and S2, and it is also possible that sector-specific ESG guidance might be introduced. So something specific to insurance sector versus banks. So those different kind of requirements and KPIs might be introduced. This direction is positioning UAE as a regional leader in climate resilient finance, and it is also aligning both with global practices as well as countries' long-term sustainability vision. And to conclude, I would like to emphasize that this has become part of the regulations. So it is like a compliance requirement. It is no longer like a voluntary adoption or a best practices that companies were earlier thinking about. The climate regulation will ensure company has resilience, has transparency, and has long-term value creation. For actuaries in general or risk manager professionals, this represents also an exciting opportunity to contribute to this sustainable growth by integrating climate considerations into every decision. And as I mentioned that we in the next topic, Jayesh will talk about this topic in more detail. And towards the end, we will be happy to take your questions. Thank you.
Thank you, Mr. Hussain, for the insightful knowledge and to update on what's happening in the market. Now, we will like to invite our next speaker, who is Mr. Jayesh Bana, who is a qualified background with a diverse financial services sector in Australia and South Africa. He has worked across a range of
You know.
critical areas with deep expertise in financial management, risk management, and product development. He will share insight on climate risk modeling, scenario analysis, and best practices drawn with international frameworks.
Thanks,
To you, Mr.
Rahim.
Tej.
Thank you so much, Rahim. Thanks, Hussein, as well, for inviting me. Let me just share my screen quickly. I think it was a good introduction in terms of what's required in the particular jurisdiction. And what I'll be covering with in a bit more detail is just taking a step back to what the standard says we should be doing. So IFRS S1 and S2, those are international standards, but there's a lot of learnings that can be brought out from that. And even the regulations in the UAE, you can see that as I go through the standard, there's lots of similarities. So what I've done is I'll try to bring that back to the requirements that's facing all banks and insurance in the UAE. So what I'll cover off is just, again, it's a shift from voluntary to mandatory. So I'll have a bit of an introduction, go through roles and responsibilities, so dive into what that means. Business impacts, identifying risk is one area that's important, but if we can't translate that to dollar numbers and how that's going to hit the P&L or other currency numbers, then it does become difficult to assess business impacts. Strategy is a big topic as well, but strategy has to be informed by the risk and the business impacts. You can't have a strategy without that. So the standard is not very prescriptive, but we'll delve into a bit of how strategy comes into play on climate. Climate, whilst everybody's seeing it as a risk, there's also opportunities that we need to be looking at. And I think businesses that go from pure compliance to looking at the opportunities and this compliance is going to lead to, those businesses are definitely going to have the advantage. And yeah, just to round it up, I am from Incredibly. I'm a director and a co-founder there. So using our actuarial knowledge, I've got a partner who's a accountant, and we've come up with a platform that actually covers all end-to-end what the compliance requirements are. We built it for Australia, but we have seen that it's got applicability in other jurisdictions. So definitely at the end, we'll work through just demoing a bit of that and what it's about, and then we'll conclude with some questions or opportunities to just think through that. So yeah, like I said, the shift is now voluntary to mandatory. IFRS S1 and S2 globally, that's in force already. Australia, UK, New Zealand, they've already adopted it, and companies are already moving to start mandatory reporting. There is a wave of how the reporting occurs. It's not everybody all at once because of the size of the business. That's a requirement. So in Australia in particular, it's dependent on the revenue, the assets, and the size of the entity in terms of number of employees, and it's group 1, group 2, and group 3. But other jurisdictions have similar cascading type reporting requirements. And I think regulators as well as the accounting standards board understand that it's a lot of new information that companies need to gather, lots of new processes they need to build. So naturally, the bigger organizations will have the resources, the time, and the finances to do that, whereas small organizations will have to get ready to do that. At the end of the day, this is IFRS S1 is an accounting compliance standard. So yes, it's including climate as a topic, but ultimately, at the end of the day, it's a accounting compliance requirement. So if we always bring it down to we need to get compliant for an accounting purposes, then it does make the calculations and all the analysis a bit easier, because that's what we're after. We're after the disclosures at the end. S1 and S2 are both international standards, but not both of the standards are actually required in most jurisdictions. For example, Australia, only S2 is mandatory, S1 is still voluntary. But if you go to other regions, S1 and S2 might both be mandatory, and there's a subtle difference between the two, but nonetheless, I won't delve into the detail. There's a lot of overlap. So whether you only doing S1 or S2, it helps to have an informed support that it brings both of those requirements through. And like Hussein just mentioned, the central bank's climate-related financial risk management regulation is landed. It's in force. Companies have to mobilize to get compliant, and again, remediation plans are required where full compliance is not possible. But I think the solutions that we have to offer will definitely get businesses compliant in a short space of time. When you look at the roles and responsibilities, naturally, any item that's a compliance-related function usually sits with the board and the CRO. Climate, on the other hand, you start bringing in a whole range of other stakeholders. And yes, it has to start with the board and the audit committee. They set the tone, they set the strategy, and the executive execute on it. The governance around this means there's policies and procedures that need to be updated. There's risk appetite statements. You got to also look at all the climate risks that come into play as well. So, the CRO definitely has a lot of more risks that they need to manage and monitor. And again, we can couple capital modeling in that scenario as well. Chief Sustainability Officer, this is going to be something new in some organizations, certainly in Australia and more countries that are more mature in their climate thinking have already put in a Chief Sustainability Officer, but this person is responsible for the strategy, the climate strategy, making sure the reporting goes out, etc. So it is a position that's going to be new to most companies, but the more support that this individual or group of individuals have is going to be important. We're certainly seeing that in Australia, where CSOs are mandated or they tasked to come up with strategy, and they tasked to calculate all the scope 1 emissions, but they don't actually have the resources to do that, nor do they have the skill set, and hence they would go to external parties to do that for them. CFO is, again, this is a accounting standard, as we said, so CFO and the finance team are key to this process, although the CFO and the finance team usually aren't in a position to actually get all the information. A good example is IFRS 17. Actuaries provide all the information and accountants ingest it. Climate is one of those as well, where a lot of the information that they need to put into the disclosures, be it modeling, be it assumptions, data, evidence, etc., they're not going to be the owners of it. So definitely the CFO is going to need support from the rest of the business. Executives and business owners, they task then to execute on the strategy. Not an easy task when you don't have control of everything. So it's going to be a juggling act within businesses, and no doubt insurance companies are going to fall into that same bucket. Actually, and analytics teams, I think they form a key part, but it's not apparent up front. We see there's a lot of the responsibility lies outside of the actuarial team, but as I'll present later on, I think actuaries really have the solution to actually bring all of that together in a very unique way. In terms of business impacts, again, risk identification, Hussein covered it off, physical risk, transition risk, those are the key standards. S1 and S2 cover that in a lot of detail, but again, the requirements in the UAE touch on that, and that's the main crux of crux of climate reporting is you've got to understand these risks. And insurance companies, for example, might not have assets that are in danger areas. Certainly in Australia, we're exposed to much more severe conditions than other parts of the world. So even if you are an insurance company, you might still be exposed to that. But other jurisdictions, the risks might differ depending on the industry you're in, and also depending on the type of services you provide. Then you got to link all of that to metrics and targets. And I think this is where the calculations start getting a bit complicated, because you have to start tracking your scope 1, scope 2, and scope 3 emissions. Scope 1 and scope 2 relate to the business entity themselves. So if you think of simplistically, scope 1 is like, your electricity and your water. Scope 2 is how do you, what depending on the industry you're in, again, for an insurance company, it's keeping the lights on, for example. And then scope 3, this information is very difficult to get because it's not the company's information, it's all your supply chain. So they call it upstream and downstream. You as an entity have to go and get all the supply chain information. So it starts then cascading out into much more data that you need to collect. So if you don't have a good solution to do that, it's not going to be easy to collate all of that, as well as then report it in a short space of time. So scope 3 is proving to be difficult to collect the data on. Scenario analysis, again, you've got to test the resilience of your strategies. So there's international standards that you can leverage off. And in terms of detailed calculations of scenario analysis, I think that's where actually step in. We sort of can understand the probability of an event happening, assess the severability of that event, and then translate that to business impacts. On the GI framework, there'll be lots of cat models that are out there already that's doing this already, but you got to think from a climate perspective as well. So it's not only, you're not insuring the risk, but you're looking at your business from that perspective. So those models do need to be tailored accordingly. And then P&L balance sheet, again, it has to translate into the financials, and then that will translate into the disclosures after that. Strategy is one that, like I said earlier, it's difficult to formulate a climate strategy, but you got to know where you start, your starting point is. So most of the businesses might dive straight into, oh, we need a strategy, so let's get a transition plan up. The way we've framed it and the solution that we've come up with is, instead of coming up with a strategy, you first understand your current position. So the standard is not very prescriptive on strategy. It is very prescriptive on the other areas, and strategy, it leaves it to the company. Much like the UAE requirements, just said you got to formulate a strategy. It doesn't really dive into what that strategy entails. So definitely organizations will already have some strategies in place. Adding climate to that is just going to compound the level of thinking around that. I won't delve too much into this because this topic, you can have a whole presentation just on strategy, but in a nutshell, what it means is that boards and executives, I think their incentives and remunerations are going to be dependent on whether they can actually execute on the strategy. It's all well and good saying we're thinking about climate and we have all of these plans in place, but I think what the regulators are looking for is not just words on a page. They're actually looking for actual execution of that as well. So that's going to prove, really tricky to execute on, but nonetheless, there's support that's probably available to most organizations. As I said, risks are the key area in climate, but what we need to also look at is the opportunities. And sometimes looking back, you'll say where the opportunities actually lie within climate. So I think from an opportunities perspective, if we just focus on that for a minute, it does mean that you'll be able to come up with new products. Your product design might be different based on, your capital that's available to you, or your underwriting that you might do in an insurance context. If you're thinking of manufacturing and other industries, they might be exposed to new markets because larger organizations want all companies to be sustainable. So if you're sustainable and you can demonstrate that, likelihood is that you might, open yourself up to a new revenue stream. Low emission technologies, that's, when we think of opportunities, we always think of, EV vehicles and putting up, or decarbonizing essentially. But that comes at a cost. So upfront, you might incur a big cost, but the payback period and the duration of that means it will be an opportunity for the business in the long run. So that has to come through in your opportunities and when you're assessing it. And like I said, transparent cost benefit and assumptions is something that we don't really think through when we think of climate, but that's what's going to have to come through not only in the strategy, but also in the scenario modeling. And if you think of the other risks, it's like Hussein mentioned earlier, climate isn't the standalone risk that you got to just do on the side. You got to embed it in the rest of your risks. So the risk appetite that you have, CRO has a function to ingest all the risks into that particular document. You got to manage it, you got to monitor it, you got to identify it, etc. You got to put capital numbers next to it to stress test it. So it's adding another layer on top of what's already there. And again, last point again, just stressing the point that it's literally specified in the requirements that the board must embed it into the governance and risk appetite. In smaller firms, definitely there's proportionality, like Hussein mentioned. Just brings us then to, the UAE's got the requirements, international standards are there. There's a lot of information, a lot of requirements, a lot of disclosure requirements, and how do you actually put all of this together for a business? And I think we mentioned where actuaries can involve. So actuaries, for those of actuaries in the room and online, you'll be very familiar with the control cycle. And I think what we've done incredibly is we've used that design thinking to say climate is something that we all need to think through a bit differently because there's just so much happening in this space. So we've set up our process that, just apply the first principles of how do you specify the problem. So, those elements is your governance elements. You work through what your governance will entail. You develop a solution, your calculations, your stress testing, etc. It's a feedback circle into that because you got to monitor the experience that comes out. Now, insurers actually are very good at that. But remember, we built a solution not only for the insurance industry, we built it for over 20 industries. So other industries don't really think through monitoring experience, and to an insurance and audience, that comes naturally, but to other industries, it's not. So we've designed it so that we can cater for other industries. And then once you get compliant on day one, that's only the starting point. You got to repeat that cycle continuously. And as businesses get more mature in the climate space, as the world moves, as climate risks start increasing, etc., the cycle is definitely going to move. So it's not a matter of just setting it up and then getting somebody to turn the handle on it. It's going to mean continuous revision, continuous coming back to the senior managers, the board, etc., to revisit what has been set up. So again, the complexity of what we're talking about is going to compound already on a lot of other compliance requirements that insurance companies and banks need to face. And then what we've also overlaid over the top is the technology enablers. So much of this is this next slide is the technology of it. It means it's very difficult for one entity within an organization to control everything. There's just too much information that needs to pass through the hands. There's a lot of data that needs to be captured, a lot of calculations. So how do then we collate all of that? So what we've designed is that we've got a SaaS platform that actually, and what it does, it gets a business compliant, and then compliance is the first and foremost requirement. Timeframes are very short, and the UAE requirement says that as well. It's landing today, and you have to be ready in a short space of time. So you need a transition plan. So again, if you've got an understanding of what other jurisdictions have done, you got a ready-made plan that you can actually start looking into. And how we've designed it and built it is much along what the framework is asking. So again, like Hussein mentioned on his slide, you got compliance, you got calculations, and you got reporting and disclosures. If you have a tool or a platform that can actually ingest information pretty quickly, which this tool actually does, you're going from policies and procedures to spreadsheets to invoices because you have to calculate your emissions. If all of that is collated very quickly into a platform and it automatically reads into what you need to calculate, suddenly you're going from compliance. You're gonna be able to meet the compliance, but then you're also able to quickly move from compliance to strategy, because I think that's where all companies want to get to. How is this going to, from a commercial lens, how is this going to improve the business? We don't want it to be a restriction on the business. Yes, you have to do the compliance piece, but you want to move quickly from compliance to opportunity. And I think, what we have in front is just that. I won't delve too much into this. I think this will be a demo on its own if we have another session, but this is just laying the platform that we already have something built that's ready to go. So just in conclusion, the message is clear, like Hussein said, climate reporting is here. It's not going away. If anything, the wave of expectations is going to increase. The regulators are going to come down hard on all organizations reporting on it. And banks and insurance companies might be the first ones to go off, but every industry is going to follow suit as well. You can see from those roles and responsibilities, it requires a concerted effort from everyone across the board within the business. But at the same time, as we all know, we don't want it to hamper business and how the business needs to actually run their business. You want it to be a compliance element that actually empowers businesses to, seek the opportunities. And I think that's where we're coming from, is that because it's a compliance requirement and it's mandatory, we can move from compliance to the competitive advantage. And certainly, like I mentioned previously, it's how you're going to improve your access to capital, trust with your clients as well. And that's a big requirement. Customers are asking for companies to be sustainable. And then also in terms of long-term performance, how can that actually impact the P&L and the balance sheet? So I'll just stop there because I think that's the end of the presentation and hand back over to him.
Thank you so much, Mr. Jayesh. Thank you, Mr. Jayesh, for that insightful presentation. It is clear that climate risk isn't just for an environment concern anymore, but a financial one that organization must integrate into strategy and reporting. We are happy to announce that DD Consulting has a partnership with Mr. Jayesh Bana, and we are organizing exclusive demos to explain our approach as well as what companies could do in the climate risk area. So feel free to contact us to request for our exclusive demos and presentations. Our next topic is the hottest topic of the Middle East right now is e-invoicing. We move to a major transformation, reshaping compliance and digital finance. To walk us through the implementation journey, roadmap, and live demo, we have Mr. Mohammed Ishad, who leads global e-invoicing projects at Flick Network, with strong expertise in compliance, regulation across UAE, Saudi Arabia, Malaysia, Spain, Belgium, Poland, and more. He helps businesses navigate evolving tax and fiscal requirements with confidence. Mr. Ishad will showcase how e-invoicing can simplify compliance, reduce manual work, and future-proof your organization's financial operations. To you, Mr.
Thank
Ishad.
you, Rahim, for that brief introduction. So thanks everybody for joining this webinar. So I'll just first give you everybody a brief introduction about Flick, so who we are and what we do. So we are one of the leading global e-invoicing service providers. So we provide e-invoicing solutions in more than 50 plus countries. So this includes countries like Saudi Arabia, Belgium, Spain, Malaysia, Singapore, Nigeria, and so on, and upcoming countries like UAE and Oman as well. So till date, we have processed more than 1 billion plus e-invoices through our platform, and we have already received 10 plus government accreditations, which I will cover in the next slide. We have also received pre-approval from the Ministry of Finance for the UAE invoicing. So this recognition has only been given to 9 vendors till date from by the Ministry of Finance, and Flick is one of those vendors. So our accreditation includes accreditation from the PEPOL authority based in Belgium. So we have already been a certified service provider for PEPOL, both for the AP and SMP section as well. And we have already received accreditation from the Malaysian Tax Authority, Saudi Arabian Tax Authority for the e-invoicing phase 2, Nigerian Tax Authority, which is FIRS for their e-invoicing operations, and Tax Authority from Belgium for the e-invoicing. And we have also received accreditation, as I mentioned, the pre-approval from the Ministry of Finance for the e-invoicing performance in UAE. So speaking about the e-invoicing compliance in UAE, it is only applicable for B2B and B2G transactions only. So if you have any kind of B2C transactions, it is completely exempted from this requirement. And we have, right now you might be generating PDF documents to perform your invoicing process. So that will be completely replaced by an XML file that will be in a pinned AE format that our solution will generate for you. And also, once we generate these XML files, it is directly reported to FTA in real time and also exchanged with your buyers as well as through the PEPOL network through our solution. So you don't have to separately email any kind of documents to your customers. So it will all happen through this PEPOL network. And FTA accredited service providers are mandated to perform this e-invoicing process. So as I mentioned, the ASP list has not been released, but the pre-approval list is released, and Flick is already a member in that pre-approval list. So now speaking about the applicability and timeline of e-invoicing. So if your company in the last financial year has a turnover of more than 50 million dirhams, which is including the B2C and all other transactions, you have to appoint an ASP by 31st July 2026. And the mandatory go live date is on 1st January 2027. So if you are a company that is part of this phase, you should never keep your deadline for 1st of January, because there could be any hiccups in the integration that could really disrupt your business. So you should plan for a go live from August or September so that you have a buffer period where you have to safely improve your business organizations. And in phase 2, the companies with turnover less than 50 million, this includes the companies that are not even VAT registered. So they will have to appoint an ASP by 31st March and go live by 1st of July 2027. And the government entities will follow from 1st of October 2027. Nonetheless, if you are going to start voluntary adoption, you can start from 1st July 2026 onwards itself, and there is no restriction for that. So I'll just get into the main element of e-invoicing. So how the data flows through the e-invoicing network. So basically, you might be using any kind of ERP, be it Oracle, SAP, Dynamics, or any in-house custom ERP as well. So through that ERP system, it will be connected to our solution, which is a Flick e-invoicing solution through an API, SFTP, or any other data integration options that are out there. Because Flick offers multiple integration options with your current ERP, so you don't have any struggles connecting your system with our servers. So once the data transfers from the supplier's portal directly to the Flick server, which can be in on-premise as well. So if you have any data governance policy or anything that says that the data should reside within your company network itself. So in that case, we can set you up an on-premise server where the data processing and archival, everything happens over there. So once the data receives at the server side, we perform a data validation to ensure that this data matches with the standards that are given by the Ministry of Finance. So as soon as we prepare the XML files, we'll send a copy to the FTA, receive their status, we'll send a copy to the buyer's ASP, which could be Flick or could be anybody else. Because just like the supplier has an ASP, your buyer will also have an ASP, so we will deliver it to them. So as soon as they give us a status, both the status from the FTA and your buyer side, both this will be updated back to your ERP system, whichever system it may be it Oracle, SAP, or any other system that you're using. Either of the systems will create custom fields where we can store that response over there. So with that process, the supplier side of transaction is completed. So how do you receive purchase invoices? So assume you are as the buyer's ERP over here, maybe using your Oracle, Odoo, Iris ERP, or any other ERP at your site. And we are staying at the corner 3. So from your supplier portal, they will send it to their accredited service provider. Their accredited service provider will deliver it to us. So as soon as we receive this document, we'll send a status to your supplier saying that we have received it. And also we'll transfer this particular document to the Federal Tax Authority for their approval once again. So every single document is sent once from the supply side and one time from the buyer side as soon as we receive it. And from there, we
Vishal,
can...
sorry to stop you. There's some blood. It's not very clear. So let me share the screen and then you continue.
Sure, that is perfectly fine. Yeah.
Yeah. Is it clear?
I mean, it's loading for me. I'm not sure for everybody it's loading or not.
No, you just need to cancel, stop sharing, please.
Yeah, I have stopped sharing.
Right. You can see the screen?
No, no, sir.
Let me do it again.
Sure.
So
It's not available, Hussein. Let me just share my screen itself once again. Okay. I hope that is fine.
no, Mr. Hussain will. Sorry for this technical issue.
Let me just do one thing. Let me just share my screen once again so you can just see if it is blurred or not. Is that fine? Yeah. Can you please check now if it is blurred or not?
It's still blurred.
It's still blurred, is it? Then I'll stop sharing for now. Yes, I think it is fine now. Yes.
Can you just talk about this again? Yeah.
Oh, okay, sure. So basically, every company, that crosses a turnover of 50 million dirhams or more in a financial year, they should appoint an ASP by 31st July 2026, and then the mandatory go live date is 1st of January 2027. So if, as per your last financial year, be it you prepared a consolidated invoice, financial statement or anything like that, it would be part of this requirement over here. So if your company is having less than 50 million turnover, or if you are not even VAT registered, so in all such cases, you will have to appoint an ASP by 31st March 2027, and the mandatory go live date is 1st of July 2027. So, and the following, the government companies will be followed by 1st of October 2027. So any company that has received the pilot testing program or the voluntary adoption, they'll have to start from 1st of July 2026 onwards itself. So this is how the applicability and timeline would be there for your businesses, depending upon the turnover that you have for your company. Rahim, you can move forward to the next slide. Yes, just to the architecture that we have. Yeah. So over here, we have 5 corners on this element. That's why it's called as a 5-corner pepper-based e-invoicing. So at the corner 1, we have the supplier, which is you who is having a particular ERP. And then at the corner 2, we have the ASP, which is Flick Network. And we are the server that will create the XML files for you. So from Flick Network, it will be transferred to the Ministry of Finance at the corner 5. And from our ASP, it will be delivered to your buyer's ASP as well. So just like how you have an ASP, your buyer is also going to have an ASP, which once they receive it, they will give us a status. And once the Federal Tax Authority receives it, they will give us a status as well. So both these statuses will be updated on that. So with that said, the supplier invoices will be all cleared with that. So when you're saying from the buyer perspective, where you are the person who is purchasing something, so in that case, you would have your ERP, which could be Oracle, SAP, or anything like that, and your supplier who is using an SAP or any other ERP at his end, he will send it to his ASP, which is their supplier ASP, which could be Flick or could be anybody else. So it's not a matter, still we'll be able to receive the invoices from them. So once they process the invoice, send it to the Federal Tax Authority and they send it to us. So we are acting as your corner 3 where we are receiving the invoice. So in that case, as soon as we receive it, we'll give a status to your by suppliers ASP saying that we have received it, and also we will be reporting it to FTA once again, so that FTA receives every particular invoice 2 times from their side. And from corner 3, we'll be automatically integrating that invoice to corner 4, where the buyer's ERP would receive it. So this is a complete flow of process where you as a purchaser and you as a supplier will be dealing with it. So you would have a question, what would happen in case if the supplier or the buyer is not in the e-invoicing network? So Rahim, can you just move to the next slide? Just the next slide. Yes. Is not in the e-invoicing network. So in that case, a supplier, which is you, who is making a sale transaction, because they are not in the e-invoicing, you are in the phase 1, they are not in the phase 2, and so on. So the supplier will have to report it to the FTA, and the FTA reporting is only enough. In that case, you don't have to share it with the buyer and so on. So that's the process, what it would happen if it is a non-PEPAL based transaction. So in this case, I'll just get into the features that we are offering for you. So we have VAT compliance reports in our dashboard that can be accessed, because even after having e-invoicing, your VAT filing process will not be automated, or it will not be auto-populated or anything like that. You still have to file your VAT returns just like how you're doing it as of right now. So we'll give you VAT compliance reports directly from our dashboard. We have ERP reconciliation reports that can help you identify if all the transactions as per your ERP has been rightly transferred to the FTA or not. And we have a three-way matching option where we can match all the purchase invoice with the PO numbers and goods receipt note at your case. And you will have access to our compliance team. So be it any industry that you're using, be it insurance or any other industry that you're working with, still we will be having a compliance team that will be able to help you with your e-invoicing compliance requirements. And if you have presence across any other countries, say for example, Oman or anything like that, where the e-invoicing is going to come. So in that case, all these countries we will be covering with just one integration for your company. And also you can have different email notifications and delivery directly from our dashboard. So Rahim, shall I just share my screen just to showcase the dashboard and things like that? Yes, thank you. Let me just know if it is still blurred or something like that, so that I can just be aware. Let me know if everybody is able to see the screen. Just log in as well to this dashboard. Yes. Is it blurred for everyone or is it clear for everyone? Rahim, if you could just give me a clarification.
Yeah, it's clear. It's clear. It's really
Okay.
good.
So in the dashboard, you'll be able to see all the details about the e-invoices, including and how many has been every month. And also over here, you have three different sections, which is send documents, received, and a trial option. So in the send documents, you'll be able to see all the transactions that has been received or sent from your system. So when you create an invoice, it will be available in our dashboard as well as in your ERP, where you'll be able to see the details about that invoice, along with the exchange status if it has been delivered to the buyer, or the reporting status if it has been reported with the FTA. So if you want, you can adjust the columns over here. And also if you want to import the transaction through an Excel file, you can click on bulk import and drag and drop your Excel files after filling in the template, and you will be able to process invoices without the requirement for an integration. So if you are using a smaller ERP and you have very low count of B2B invoices, you can definitely use our create document option over here, where you can fill in the options, including the invoice number, the date of invoice, and such other details over here, including your customer details and your line entry information, in order to create these invoices directly from our dashboard without the requirement for an integration. So any document that is failed, you can just click on that document, see the details about that document, and see what are the errors that are there. Say for example, invalid country code or date format is wrong. So in any such cases, the errors will be showing and populated directly for you to see it from the system. And in the receipt section is where you'll be able to see all your AP purchase invoices that has been created. So when you receive a self-built invoice, or you create a self-built invoice, or you receive a purchase invoice from your suppliers, that will all be appearing over here. So you can just click on this particular invoice to see the details about that particular invoice, what is the line item, what is the quantity, and all such informations will be available in this dashboard. If you ever wanted to see how the PDF document of such a transaction would look like, you can definitely just click on this download button. So we have a feature where we convert every particular XML invoice into a PDF invoice, so that you can directly view it as a PDF document. And speaking about the other features that are there, So if we go to the report section, we'll have document register, we have reconciliation reports that is able to reconcile with your ERP and your tax returns as well. And we have monthly invoice report, cumulative invoice reports, and so on that will be directly accessible from our dashboard. So if in case you require any kind of support, you can directly access the support options from here, where you can email for support, or if you want to call us, you can do that, and you will have a chat option, and you can directly create tickets from our dashboard as well for any kind of support that you would have. So apart from this, we have an admin portal where you can manage your users and all such things. So basically over here, you can manage your users. So you can have as many users as you wish, depending upon the role that you're going to give them. So we have a role-based access control that is available, where you can decide what is the permission that you're going to give to a particular user. If we want to have access to a specific report, if we can send documents, if we can see the received documents, or any particular legal entity, all these options you can configure directly from our dashboard. So over here as well, you will be able to see the audit trials and all such details that will be available over here in order for your admins to manage all such things directly from here. So that's a brief overview. There's a lot more features that, because of the constraint of time, I'll just skip it for now, but you can definitely request for a full demo to showcase all that. Maybe Rahim, you can just the presentation.
Thank you.
About the security sector, yeah.
Thank you, Mr. Ishar, for the practical, insightful session. The demo really brought to life how digital invoicing is transforming the way businesses manage compliance. I am sorry to everyone that we had faced some technical issue, and that's why the presentation was not clear. But whoever has emailed us, we will sharing the link of this webinar, or as also the presentation for the e-invoicing. So sorry for that. We are happy to announce that DD Consulting and Flick has a partnership to support our clients in their e-invoicing journey. Please free to request for an exclusive e-invoicing demos, both in person and online, without the glitch, for organizations that wish to experience it firsthand with our partner Flick. Our next and final presenter is for ICOFR, Internal Controller over Financial Reporting, to share what's changing in the 2025 audit landscape and how you can prepare your organization for these updates. Please welcome Mr. Fahim Malik, who is a senior financial and investment analyst with experience in valuation, investment analysis, ICOFR, and risk assessment. Fahim has supported multiple insurance companies in the UAE on ICOFR related projects and will be taking you through the key requirement during this session.
Yeah, hi guys. Thank you for joining us today. I'm Fahim, and I have been part of DD Consulting since 2024. I hold a master's degree from University College London, and I am a CFA FRM, CAIS, CIPM charter holder, and ACCA qualified. So today we are going to briefly talk about internal controls over financial reporting, also known as ICOFR, its key components and related regulatory requirements. The next slide. Let's first start with the importance of ICOFR. ICOFR is essentially the backbone of financial reporting quality. It is not just a compliance exercise. It helps organizations build trust with regulators, investors, and its own management. ICOFR ensures that ICOFR ensures that controls are designed well and they are operating effectively. Errors and frauds are either prevented or detected on timely basis. The financial statements remain accurate, reliable, and complete. Responsibilities are well allocated, and there is ongoing compliance with the regulatory requirements. Strong ICOFR also ensures smooth audits and workflows with improved financial performance. Next slide. ICOFR needs to be in line with the KSA framework, which is the global standard for internal controls and is widely used by the auditors when forming their opinions. KSA framework focuses on 5 essential areas. First is the control environment, which requires a strong ethical and governance structure at the top of the organization with clear defined roles and high importance given to the ICOFR. Then we have risk assessment, which involves identifying risks, assessing and rating the risk based on the impact and likelihood, and taking measures to reduce or eliminate those risks. Then we have control activities, which are the controls and measures that prevent risks. Then data and communication refers to timely and accurate flow of information within an organization to support the control operations. Finally, ongoing monitoring requires regular testing, follow-ups, continuous improvements to ensure that controls stay effective. Next slide. Yes, so ICOFR divides the controls into 3 main areas. First is the entity level controls, which set the overall foundation for a strong control environment, integrity, and accountability. It includes areas like governance structure, ethics, policies, and committees. Then we have process level controls, which are the department level controls, which should be maintained by each specific department, like underwriting department, claims department, reinsurance, or finance department. These covers areas like document retention, delegation of authority, and approvals. Then we have IT general controls, which ensures that the systems and data used for financial reporting is secure, accurate, and it is properly governed. Each control needs to be properly aligned with the key financial statement assertions like completeness, accuracy, validity, and proper presentation. Next slide. As I previously mentioned, that ICOFR adds true value when it is fully embedded into the daily operations rather than only being treated as a compliance requirement. In a mature ICOFR environment, the workflows are clearly documented, SOPs, process maps, and RCMs reflect reality. Risks are directly linked to the controls, and every control owner understands their responsibility. There should be proper segregation of duties, and every control performed must be supported with proper evidence. And finally, there should be ongoing testing and monitoring, and any identified gaps should be closed in timely manner. Next slide. Now, in terms of the UAE regulatory requirements, as you know, ICOFR is mandatory for all UAE regulated insurance companies. Now, external auditors will also issue separate opinions on whether controls are designed properly, whether they are operating effectively, and to meet these expectations, insurers must maintain and update the documentation of SOPs, process flows, and process entity and IT level RCMs. And also the insurers should present they should present evidence for control testing and execution. And also they should ensure that controls are aligned to the KSA framework and financial statement assertions. And also it is important that there is ongoing active oversight from the audit and risk committees, and there is ongoing monitoring and remediation of any identified gaps. Last year, there was a requirement from the central bank on the submission of the ICOFR gap report. We might see something similar this year as well, and the scope of ICOFR will broaden over the period of time. Next slide. Okay, so we have supported multiple clients on the ICOFR across the UAE insurance sector. So we often notice that the controls or SOPs and process flows, RCMs, are often weak or they are outdated. Employees are not well trained on the use of controls. There is lack of ongoing monitoring. There is unclear control ownership and segregation of duties. Testing evidence is not retained properly, and there are delays in remediation of gaps. Next slide. Okay, so as I previously mentioned that at DD Consulting, we have supported multiple insurance companies in gap assessments, trainings, and improving the overall ICOFR framework. So our activities have covered the reviews of SOPs, process flows, RCMs at entity level, process level, and IT level. And also we have held detailed discussions with the HODs. We have tested the design and operating effectiveness of controls based on the sample. Also, we have reviewed the previously identified gaps. We have provided the detailed gap report, and also we have provided the detailed remediation plan to fix the gaps. So yeah, that's all from my side. If you guys have any queries or feedback, please feel free to reach us out. Thanks.
Thank you, Mr. Fahim, for those valuable insights. Clearly, the way we approach internal controls today will define our organization remain tomorrow. Now, let's have some question and answer session. Okay, so we'll just start with some question and answers which we had received. What is the first practical checklist we can follow to begin climate risk reporting under IFRS S1 and S2 in the UAE market?
Yeah, happy to take that one. Yeah, so in terms of a checklist, the standard pretty much guides us in terms of what we should be doing. The UAE is no different. It's just a subset of the full IFRS S1 and S2. So in terms of our solution, we've already got the checklist up. We're saying, there's a gap analysis that each company needs to do. You need to have your governance and compliance in place, the board assessment, the risk assessment. So the diagram that I showed on the second last slide of my presentation, pretty much that's the checklist that you start off with. And based on the particular jurisdiction, you'll taper that down because you might not need everything in there. And first step would be to, meet the bare minimum that the requirements are asking you for. So definitely that checklist is already there. It's, used in international standards, but we can always taper that back to the UAE. So much of that has already been scoped out, like I said, in our solution. And it's just a matter of sitting down and ensuring that each business can adopt it when they start taking this exercise on.
Yeah, the next question is, do companies need to engage directly with the UAE People Authority, and how will e-invoice be exchanged with overseas customers? Into this, Mr. Ishad.
So you don't have to directly engage with the PEPOL authority, but the onboarding process definitely happens through the MR tax portal, where you can just send the invoices directly through an ASP. So the ASP is the one that will be directly linking with the PEPOL authority. And with the overseas customers, you have to only report the transactions with FTA, and there is no requirement that you have to exchange the invoice with overseas suppliers. You just have to report it with the FTA authority. I hope that is clear to you.
I have a question on climate risk regulation. How is the new climate risk regulation expected to influence the insurance industry, underwriting, investment, and risk management practices, particularly in the terms of integrated climate-related disclosure and scenario analysis?
So a lot of it's a big question that maybe just slow it down a bit. I didn't get the first bit. What was the first bit?
So how is the new climate risk regulation expected to influence the insurance industry, underwriting, investment, and risk management practices?
Yes, I think like we mentioned, it's unknown at this stage, right? Nobody knows what the impact is going to be. But from an assessment perspective, yes, we can definitely include those risks into the current risk appetite framework. And businesses then need to start having a look at what does it mean for the business. Now, every organization, even in Australia, is early on in that journey. So, the pilots have been put up, risk has been put into the particular insurance company's framework. And again, when you go down the climate route, insurance is probably at an advantage because we've been doing this a long time in terms of capital stress testing. We've been coming up with scenarios. So it's actually the easier one, the industry that will actually adopt climate pretty quickly. And also, if you think of an insurance company, have a lot of knowledge within the business in terms of managing the risks. So in terms of adopting it for insurance companies, definitely there'll be an impact. At this stage, it's dependent on each particular insurance company, what products you're selling, what jurisdiction you're in. So it's a lot of information that you need to do. But in terms of having a simple answer in how it's going to impact, I think, impacts on the P&L and balance sheet, impacts on operational flows. And the main one is that it's a compliance issue that companies will have to put resources onto, and also the supply chain. You got to understand your supply chain. Even as an insurance company, you'll have a supply chain, so you got to understand those for your Scope 3 calculations.
Thank you. Mr. Shad, one question for you. As per UAE MOF notification number 243 of 2025 on the electronic e-invoicing system, issued in September 2025, Article 4 exclusion specifies that business transaction involving financial services that are exempt from VAT or subject to VAT at the zero rate are considered excluded transactions. Now the question is, does this mean that all exempt supplies and zero rated transactions are outside the scope of UAE e-invoice regulations?
Not really. So if you have a zero rated transaction, an exempt transaction, or an out of the VAT scope transaction, or for that matter of fact, even an intercompany transaction, all these are required to be done through e-invoicing. So the only exemption is there for airway bill transactions and these financial transactions that are exempted, which is mainly interest on loan and such other details as per that particular article. So only those are excluded. The rest are fully part of e-invoicing itself.
What internal controls are needed to ensure the integrity of e-invoicing and climate disclosure? That's for you.
Yeah. So yes, please.
Sorry, that's. I think it's both of you.
Yeah. So both of these two are separately to be taken care, specifically because e-invoicing is something that comes along with the VAT law, and maybe Jayesh could comment on the climate risks that is involved. But from an e-invoicing perspective, definitely yes, you have to get your gap analysis checked to see if all the technical fields are available and things like that to ensure you're compliance with that requirement. Maybe on climate, Jayesh, you can.
Yeah, sure. On climate is no different. You got to understand the gaps in terms of your financials, and there's a requirement both on S1 and S2 in terms of the disclosures that you need to stand up in your financials. Now, if you are publicly listed companies, those will become more detailed. You need to include. If you're not listed, it will be at a lower level. But that being said, disclosures within each jurisdiction will be different because a regulator will request some further information. So you have to look at it holistically. But what businesses can do is see what other companies similar size are doing in other jurisdictions, and that can inform how their disclosures would look. If you stick to the IFRS S1 and S2 standard, you pretty much cover all your bases because each regulator will use that or adopt a portion of that. So yeah, from a disclosure perspective, S1 and S2, it covers off everything that you need to have, and the finance teams will have to get that up into the packs as well.
I don't know if I missed this question. How can informal sector workers be included in climate IR? Okay, how can informal sector workers be included in climate risk management invoicing, especially in developing economies?
I can pick up the climate one first. So maybe I'll reframe the question in terms of smaller organizations. So yeah, informal. There's a limit in which you have to report on climate, right? It's not going to be every single entity, but if you think of the largest entities if you look at the largest entities, the top 100 companies, and you cascade it down to all the smaller companies. Now, the main thing is that those large companies have to report on climate. The smaller companies, there might be supply chain into the larger companies. So definitely at some point, they're going to have to also be mandatory to report. Now, the regulator might not point a finger at the smaller organizations at this stage, but that will come in 2026 and 2027. And for those smaller entities, having something that's low cost, quickly to ingest information and get an output is key and vital. And again, like the solution we have caters for that, because you can't have a small entity that doesn't know much about climate and doesn't have the resources nor the the finances to get consultants in. We want to support those smaller entities as well. So the tool we have will cater for that, and that will cascade up into the bigger entities.
Okay. Also, can you please inform us how we can choose one or two basic climate scenarios and a small set of metrics to get our first report done this year?
Yeah, so climate, our tool has already ingested the international. So with this 3 scenarios that the international standards have come up with, they've got the temperature changes, etc. So that's the high level assumption. So we can ingest information in there, and again, it's high level OPEX, revenue, assets, etc. And you put that in, and it will calculate. It's very formulaic, and we've built that into our platform. We have the high level one that all entities on day one can use to be compliant. And then we have the detailed one. And I think that's the actuarial calculation and the model that we've built. So as a company can get compliant on day one, they might then look to go to the detailed level. But certainly we have the capability to do both. Should a company be ready at this stage to, if you want to go detailed, we can do detailed even on day one. It doesn't stop them. But if there's a need to just do the high level one, that's already been built in.
From Ishad, there's a question for e-invoicing. Which countries have adopted it already, and how UE is going to be different compared to other markets?
Yeah, so definitely, as a lot of countries have already gone live with e-invoicing, 5-6 years back itself. So these countries includes Italy, Saudi Arabia, Egypt, Jordan, and India, and so on. So even Malaysia and Singapore has also introduced their own e-invoicing model. So how it differs from other markets is mainly because in some countries they adopt just the reporting process with the tax authority, where you get a QR code which needs to be placed on the PDF and so on, just like how we have in Saudi Arabia, Egypt, or Jordan, and so on. But PEPAL-based e-invoicing is same across other countries that has implemented PEPAL, especially UAE, Belgium, Germany, and so on. So whichever country has PEPAL-based e-invoicing, it is all according to the same standard that we have in UAE itself. I hope that clarifies.
There's some questions, but we will answer as much we can. Yeah. The UE requirement only applies to B2B invoices. Are B2C going to come in future?
Yeah, so actually it is not applicable only for B2B. It is applicable for B2B and B2G as well. So business to business and business to government transactions as of right now. So B2C is mentioned on the ministerial decision that it is yet to be decided. So until further notice, it is exempted. So at least for the foreseeable future, maybe for 4 or 5 years, you don't have to really worry about B2C invoices being part of the e-invoicing mandate. So for now, you can just focus on B2B and B2G transactions.
Okay, there's a question over here. A circular from SCA delaying phase 1 of ICOFR to end of 2026. Is there anything that we can see from central bank which brings out to such extension? Mr. Sen, if you can.
Yeah, the circular from ESCA has surprisingly came out like yesterday or the day before yesterday, whereas the expectation was that from this year the external audits will start for ICOFR, which the central bank has been talking about from last year. So even though ESCA circular has been issued, but we are yet to see how central bank comes out with its requirements. So and as companies were already gearing up for the external audit of ICOFR, so I have in my opinion, I mean, central bank might still continue the old roadmap, which would be that having the external audit required for ICOFR. but we have yet to see. So I would say this has impacted the insurance companies, but I would say that insurance companies should continue with the original plan until central bank issues different regulations.
We'll just going for the last question now. There's a couple of questions coming in, but we'll just do the last. Couple of advantage to company complying with climate risk management or ESG compliant versus companies not complying from business growth perspective and integrating with global companies viewpoint.
Yeah, there's always, I mean, if the regulators are knocking on everyone's door, then there's a need to be compliant. I think from a regulatory perspective, you don't want to be on the wrong side of the regulator. So first up, because it's mandatory now, there's always an advantage to be compliant. And like I said earlier, you don't want compliance to hamper the business down. You don't want a black tick against you. The regulators, knocking on your door saying, "Where's your compliance?" So ESG sort of falls in the same bucket. You have to have these reports up, and it's becoming a norm now. So your clients are also expecting it. Investors are expecting it. That in itself is an advantage if you already tick the box early on and then you get on with your normal day-to-day business. You don't want it to be the thing that's a cloud hanging over you. So I think there's always going to be an advantage to get it up quickly, get it out of the way quickly, and then monitor it. If it's going to be an organization that drags their feet to do it, it's going to catch up with you eventually. And that's not the type of marketing that you want to your business, that you're not regulatory compliant. And big organizations definitely will start getting a lot of fines, etc., because the regulator is not going to accept that it's not possible. And they did say that you're gonna have to explain why you're not compliant. You don't want to be ending up spending more time explaining yourself. Rather just get compliant, and then you can move on. Doing the normal day-to-day business.
Thank you so much.
Hussein, maybe you want to add to that. I know there's not enough time, but maybe from your viewpoint.
No, I think you have already explained, and we have yet to see. I mean, more things will come out, but yeah, I think you already covered and explained everything.
Yep.
So big thank you to our speakers, Mr. Jayesh Shibana, Mr. Hussein Feroz, Mr. Fahim Malik, and Mr. Mohammad Ishad for sharing their expertise, to all of you for joining us from all across the globe. Before we close, a quick reminder: if you want to request for a demo for e-invoicing or climate risk or ICOFR, please send us an email. Our email is already mentioned in the chat box. Share your feedback, and we will share with you the link for the webinar and the presentation for it.